Hey everyone, today we're diving into a big question. Should you be buying Chinese stocks listed on NASDAQ like Alibaba, Pinduoduo, Baidu, JD.com, and the KraneShares CSI China Internet ETF, KWEB? These names have been volatile, with massive potential but also significant risks. In this video, we'll explore why they've lagged behind the broader market, their dividend policies, including Alibaba's recent payouts, the rewards if the market turns in their favor, geopolitical risks, and more. We'll use the latest stock data, like the real-time prices shown in the finance card above for BABA, to keep things current. This is a packed analysis, so grab a coffee, settle in, and let's figure out if these stocks are a golden opportunity or a risky bet in today's market. By the end, you'll have a clear picture to make an informed decision for your portfolio. Let's jump in. Welcome back to the Trade Savvy Academy. If you're new here, hit that subscribe button and ring the bell so you don't miss our deep dives into investing and trading. Let's start with why Chinese stocks like BABA, PDD, BIDU, and JD have been lagging behind the U.S. market, such as the S&P 500. Over the past few years, these stocks have faced a brutal combination of headwinds. From 2020 to 2022, the iShares MSCI China ETF, MCHI, dropped 21.7% in 2021 and 22.7% in 2022 in 2022, while KWEB, focused on Chinese internet stocks, fell 48.9% in 2021 and 17.2% in 2022. Meanwhile, the S&P 500, despite its own dips, didn't see losses that severe. China's strict COVID-19 lockdowns hammered consumer spending and supply chains, hitting e-commerce giants like Alibaba and JD.com hard. Beijing's regulatory crackdown added fuel to the fire, targeting tech firms with anti-monopoly fines and restrictions. Alibaba faced a $2.6 billion fine in 2021 for antitrust violations, and its affiliate Ant Group's IPO was cancelled, reportedly after Jack Ma criticized China's financial system. This sent Baba's stock from over $300 in 2020 to a low of $79.21 in 2024, as seen in the finance card above. Baidu, JD, and PDD also struggled, with share prices well below their 2021 highs. China's economic slowdown, including a property market crisis and high youth unemployment, further eroded investor confidence. Posts on X from 2024 note that these stocks trade at low forward PE ratios, around 7 to 10 for BABA, BIDU, JD, and PDD, compared to U.S. tech giants like Amazon at 30-plus times earnings, reflecting deep market skepticism. This lag stems from a mix of policy, economic, and sentiment challenges that have kept these stocks under pressure. Now, let's break down the companies and KWEB. Alibaba, often called China's Amazon, dominates e-commerce, cloud computing, and digital payments. Its Taobao and Tmall platforms hold a massive share of China's online retail, though Morningstar notes it's losing ground to PDD and Douyin, with its gross merchandise volume to online retail sales ratio dropping from 72% in 2022 to 62% in 2023. BABA's current price, as shown in the finance card above, is $119.99, with a market cap of $289.45 billion and a 52-week range of 79.21 to 148.43. Pinduoduo has disrupted e-commerce with its group buying model, targeting lower-tier cities with steep discounts. Its stock surged in 2024 after China's stimulus announcements, showing its sensitivity to policy shifts. Baidu, BIDU, China's leading search engine, is investing heavily in AI and autonomous driving, leveraging its vast user data. JD.com focuses on authentic products and robust logistics, recently prioritizing profitability over expansion. KWEB, the KraneShares CSI China Internet ETF,
tracks 33 Chinese internet stocks, with top holdings like Alibaba, PDD, and Tencent accounting for about 60% of the fund. Its expense ratio is 0.69%, and it doesn't pay dividends, focusing on growth. On dividends, Alibaba recently started paying, with a $0.95 per share annual dividend as of July 15, 2025, yielding 0.81%, though some sources report a $1.98 payment on July 10, 2025, for a yield of 1.63%. PDD, BIDU, and JD do not currently pay dividends, reinvesting profits into growth areas like AI and logistics. Alibaba's dividend, while modest compared to U.S. dividend stocks, signals confidence in its cash flow, with a payout ratio of 22.35%. The risks of investing in these stocks are substantial, starting with geopolitical tensions. U.S.-China trade disputes have intensified, with tariffs potentially rising from 30% to 145% if no truce is reached. In January 2025, reports of U.S. AI chip export restrictions hit companies like Baidu, which relies on advanced tech for AI development. President Trump's America First investment policy and Treasury Secretary Scott Bessent's comments about everything being on the table have fueled delisting fears for Chinese ADRs. Goldman Sachs estimated a 66% delisting probability in April 2025, projecting a 9% drop in ADR valuations and $250 billion in forced selling. Alibaba, with 26% U.S. institutional ownership and a Hong Kong listing, is less exposed, but PDD, without a Hong Kong listing, faces higher risk. Regulatory risks are dual-sided. The U.S. SEC can delist non-compliant Chinese firms after 2 years of audit issues, per 2020 rules, while Beijing's crackdowns continue, as seen with DD Global's NYSE delisting. China's economic challenges, property market declines, 5.8% year-over-year in September 2024, and uneven consumer spending add pressure. KWEB's concentration, with 61.9% in its top 10 holdings, increases volatility compared to broader ETFs like MCHI. Currency risk is another factor. The yuan weakened to 7.3049 against the dollar in April 2025, impacting U.S. investors' returns. These risks, geopolitical, regulatory, economic, and currency, make these stocks a high-stakes bet. If the market reverses, though, the rewards could be significant. These stocks trade at low valuations. Alibaba's forward PE is around 8 to 10, Baidu and JD 7 to 9, PDD 10 to 12, versus Alphabet's 20.7. The finance card above shows Baba's year-to-date gain of over 48%, reflecting a 2024 rally driven by China's stimulus, including $140 billion in liquidity from rate cuts and reserve reductions. Alibaba, PDD, and JD saw single-day gains of 7 to 11% in September 2024 after stimulus news. KWEB gained 25.3% year-to-date by March 2025, outpacing the S&P 500's 10.8% rebound. Analysts like Deutsche Bank see China's AI innovation, led by firms like DeepSeek, driving growth, with Alibaba and Baidu integrating advanced AI models. Goldman Sachs projects $200 billion in inflows if sentiment shifts. Investors like David Tepper and Michael Burry have increased stakes in BABA, JD, and PDD, betting on undervaluation. Alibaba's cloud revenue grew 13% with triple-digit AI product growth. Baidu's AI search dominance remains strong, and JD's logistics efficiency supports profitability. PDD's focus on lower-tier cities taps China's growing middle class. KWEB could ride a broader tech rally, especially with China's $2.1 trillion in retail web sales in 2023 versus $1.1 trillion in the U.S. A sustained economic recovery, perhaps with an $850 billion bond package, could push these stocks higher. Geopolitical issues are critical. The US-China trade war, with tariff threats and a 90-day truce extension in August 2025, creates uncertainty but also opportunities. BABA, PDD, and BIDU gained 3 to 6% on truce news. China's countermeasures, like yuan weakening and state fund buying, provide short-term support but don't address long-term risks like isolation, as Motley Fool warns. Alibaba, Baidu, and JD's Hong Kong listings offer a buffer against US delistings, unlike PDD. Corporate governance is a concern. Chinese firms face transparency scrutiny, but Alibaba's improved ties with Beijing, evidenced by Jack Ma's 2025 appearance with Xi Jinping, reduce some risks. Traders can capitalize on volatility. These stocks often move 7 to 12% on news. Long-term investors should focus on fundamentals. Alibaba's $221.9 billion March quarter revenue, plus 7% year-over-year, Baidu's AI leadership, JD's profitability shift, and PDD's growth in smaller cities. KWEB's exposure to these names makes it a diversified play, but its concentration requires caution. Sentiment on X is optimistic, calling these stocks undervalued gems for 2 to 3 year outperformance. You can also follow me on X on the account shown on the screen for my latest trades and investments. Other factors? China's uneven recovery, 4.7% GDP growth in Q4 2024 but persistent property and debt issues could cap gains. Alibaba's dividend, 0.81 to 1.63% yield, adds appeal for income seekers, though PDD, BIDU, and JD's lack of dividends may deter some. For traders, these stocks' sensitivity to news makes them ideal for short-term plays. Long-term, their low valuations and growth in AI, cloud, and e-commerce suggest upside if risks subside. Should you buy? If you're risk-tolerant and believe in China's recovery, BABA, PDD, BIDU, JD, and KWEB offer value, especially with Alibaba's dividend and potential 20 to 50% gains in a bull case. If geopolitical or regulatory fears loom large, wait for clarity, like a sustained truce or more stimulus. Always consult a financial advisor and do your research. What's your take? Bullish or cautious? Drop it in the comments. Like, subscribe, and share this video. Stay smart and invest wisely.